Module objective. The objective of this module is to explore the various risks inherent in agricultural commodity trading and to provide detailed insights into risk mitigation strategies, particularly through the use of insurance instruments, hedging tools, diversification, and technology. By the end of this module, you should understand the types of risks in agricultural trade, methods to evaluate and manage these risks, and how to leverage agricultural insurance schemes and market-based instruments to enhance resilience and profitability. Understanding risk in agricultural commodity trading. Agricultural trade is a high-stakes sector vulnerable to numerous unpredictable risks, many of which are beyond the control of farmers, aggregators, or exporters. These risks can stem from natural disasters, price volatility, policy shifts, logistical disruptions, pests and diseases, and even geopolitical tensions. Unlike manufactured goods, agricultural commodities are perishable, weather-sensitive, and highly seasonal. This makes risk management an essential part of strategic planning and business continuity in the agribusiness value chain. 2. Categories of agricultural trade risks. Here is an expanded breakdown of the common risk types. 1. Production risk A arises from unpredictable weather conditions, drought, flood, storm, pests, and diseases. B. Poor yields or total crop failure affects supply consistency and contractual obligations. 2. Price or market risk A fluctuations in market prices due to demand-supply imbalance, exchange rates, or global economic trends. B. Especially common in export-oriented commodities like cocoa, coffee, sesame, cotton, and grains. C. Farmers and traders may suffer losses if market prices fall below production costs. 3. Logistics and infrastructure risk. A. Poor roads, port congestion, broken-down trucks, and storage failures can lead to spoilage, contamination, and delayed shipments. B. Time-sensitive goods like vegetables and dairy are most affected. 4. Financial risk A, linked to inability to access affordable credit, repayment defaults, inflation, and interest rate hikes. B. Affects the working capital needed for input purchase, warehousing, transport, etc. 5. Political and policy risk A includes changes in export bans, import duties, regulatory restrictions, and government subsidies. B. Can render trade unprofitable or legally impossible overnight. 6. Reputational and quality risk A occurs when goods are rejected due to poor quality, non-compliance with buyer specs, or food safety violations. B. Damages brand and causes financial loss. 3. Risk mitigation strategies in commodity trade 1. Diversification A. Do not rely on one commodity, one buyer, or one market. B. Traders and farmers should spread investments across multiple products, regions, and trading partners to reduce exposure. 2. Contract farming and forward contracts, ILE. Enter agreements with buyers in advance to lock in prices and volumes. Reduces price uncertainty and gives assurance to both parties. 3. Use of warehousing and aggregation centers. Proper storage reduces post-harvest losses. Aggregation centers allow bulk handling and quality standardization. 4. Quality control and certification compliance with global standards, GAP, HACCP, Organic, reduces rejection risks. Certificates build buyer confidence and open new market access. 5. Hedging in commodity markets. Traders can use futures, options, or swaps to protect against price volatility. Example: a sesame trader can lock in a future selling price through a commodity exchange. 6. Building relationships with reliable logistics partners. Timely transport, temperature control, and efficient tracking systems help avoid delivery delays and spoilage. 4. Agricultural insurance mechanisms. What is agricultural insurance? A financial product that compensates farmers and traders for losses arising from predefined risks such as drought, pests, disease, fire, and price crashes. Types of agricultural insurance. A. Crop insurance covers physical loss or reduced yields due to weather events, pests, or disease. Examples: Nigerian Agricultural Insurance Corporation, NAIC, crop cover, Kenya. B. Livestock insurance. Protects against loss of animals due to disease outbreaks, theft, or accidents. C. Index-based weather insurance payouts are triggered when weather parameters like rainfall or temperature cross a threshold. Affordable and scalable for smallholders. D. Revenue insurance covers income shortfall due to either low yield or low price. E. Transport and warehouse insurance protects goods in transit or storage against fire, theft, spoilage, and natural disasters. Export credit insurance, offered by export credit agencies like Nexim Bank, Nigeria, Afrexim Bank, protects exporters from non-payment by foreign buyers. V. Integrating risk management in agribusiness planning. An effective agribusiness must develop a risk management plan (RMP) as part of its business operations. This plan should include A. Risk identification and ranking. B. Preventive strategies. C. Contingency budgets. D. Insurance options. E. Data-driven monitoring and evaluation. Farmers, cooperatives, and commodity firms should also invest in early warning systems, such as A. Satellite weather monitoring. B. Mobile alerts for disease outbreaks. C. Market price trend analysis. 6. Case study: Sesame exporters in Nigeria. Sesame is one of Nigeria's top export commodities. However, it faces frequent rejection in global markets due to high pesticide residue and microbial contamination. To manage this, sesame exporters: A. Use certified inputs. B. Train farmers on good agricultural practices. G. A, P, C. Invest in pre-shipment inspection and third-party testing. D. Ensure warehouse sesame against fire and theft. By implementing a robust risk and insurance framework, they have reduced export rejections and increased profits. 7. Role of government and donors in risk mitigation. Governments and donor agencies play a critical role by A. Subsidizing insurance premiums for farmers. B. Supporting commodity exchanges to enable hedging. C. Funding capacity building on quality control. D. Providing data platforms for weather and price updates. E. Facilitating cross-border trade agreements and policies.